89% of all the money in the United States was not created by the government. It was not printed by the Federal Reserve. It was created by commercial banks. When a bank approves your mortgage, it does not open a vault. It does not move someone else's savings into your account. It types new numbers into a screen. That money did not exist 5 seconds earlier. $21 trillion in the U.S. money supply. Only $2.3 trillion of that is physical cash. The other $18.7 trillion was created by banks, out of nothing. This is not a theory. The Bank of England published it in 2014. In their own words, I am going to show you exactly how they do it. The accounting trick that creates money from nothing. The textbook lie they teach in every economics class. The reason why asset prices keep rising while your wages stay flat, and why the entire economy depends on one thing, your willingness to go into debt. This is documented by the central banks themselves. Here is what they taught you in school. Banks are intermediaries. They take money from people who save and lend it to people who borrow. 100 people deposit $1,000 each. The bank holds some in reserve and lends the rest out. The money multiplier. It is in every introductory economics textbook published in the last 60 years. Mankiw, Samuelson, Blanchard, all of them print the same diagram. Deposits in, loans out. Simple. There is one problem. It is completely wrong, not simplified. Not a useful approximation. Wrong. The Bank of England said so in 2014 in a paper titled Money Creation in the Modern Economy. The Bundesbank confirmed it in 2017. The Federal Reserve's own research papers have acknowledged it since at least 2012. 3 of the most powerful central banks on Earth have publicly stated that the textbook model of banking is fiction, and yet it is still being taught in universities today to millions of students as fact. So if banks do not lend out deposits, what do they actually do? Here's the mechanism. And once you see it, you will never look at your bank account the same way again. When you walk into a bank and sign a mortgage for $300,000, here's what does not happen. The bank does not check how much money it has. It does not call up its depositors. It does not transfer funds from one account to another. None of that happens. Not 1 cent moves. Here is what does happen. The bank creates 2 new entries in its books. On one side, an asset, your signed promise to repay $300,000 plus interest over 30 years. On the other side, a liability. $300,000 freshly deposited into your account. 2 entries, created simultaneously, from nothing. The money in your account did not exist before you signed the loan. The bank did not have it. Nobody had it. It was brought into existence by the act of lending itself. This is not a metaphor. This is the actual accounting. Think of it this way. Imagine you could write I owe us that everyone in your neighborhood accepted as cash. You write someone an IOU for $100,000. They deposit your IOU at the grocery store. The grocery store pays its suppliers with it. Your IOU is now circulating as money. You created it from nothing. You owe nothing to anyone except the person you wrote it to. That is exactly what a bank does. Except the bank's I owe us are called deposits, and the entire economy runs on them, and one economist proved it empirically. Richard Werner, the same man who coined the term quantitative easing, conducted an experiment in 2014 at a small German bank called Raiffeisenbank Wildenberg. He borrowed 200,000 euros, and he watched, in real time, what happened inside the bank's accounting system. No money was transferred from any other account. No reserves were moved. The bank simply typed the amount into his account. Created it. He published the results in the International Review of Financial Analysis. Peer-reviewed. Irrefutable. But here is where it gets darker. Because this does not just mean that your bank lied to you about how loans work. It means that almost every dollar in the economy is someone's debt. Think about that. If banks create money when they lend and destroy it when loans are repaid, then the money supply is not a thing that exists on its own. It is the total amount of outstanding debt. The $21 trillion circulating in the American economy is not wealth. It is the sum of everyone's unpaid loans. Your mortgage, your neighbor's car loan, your company's line of credit. Remove the debt, and the money vanishes. And here is the trap that nobody explains. The bank creates the principal, the $300,000. But the bank does not create the interest. Over 30 years at 7%, you will pay the bank $419,000 in interest alone, more than the original loan. That money was never created. It does not exist in the system. So where does it come from? From someone else's loan, from someone else's principal, which means there is never enough money in the system for everyone to pay back what they owe. Someone always has to default. It is musical chairs, and there are always fewer chairs than players. Now here is the part they really do not want you to understand, because if banks create money when they lend, then whoever the banks decide to lend to decides where new money enters the economy. Not Congress, not voters, not the free market. Banks. And for the last 30 years, banks have made a very clear choice about where to direct that new money. In 1970, mortgage lending made up about 35% of total bank credit in the United States. By 2007, it was 70%. Banks did not double down on funding new businesses, research, or manufacturing. They doubled down on real estate, because real estate is collateral. The house you buy with the loan secures the loan itself. If you default, they take the house, risk-free money creation. And every new mortgage pushed house prices higher, which justified larger mortgages, which pushed prices higher still. A self-reinforcing loop of money creation aimed at a single asset class. This is why home prices went from a median of $47,000 in 1980 to $420,000 in 2024. Not because houses became 9 times better, because banks created 9 times more money chasing them. In 1980, a median-income household could buy a median-priced home with 3 years of earnings. Today, it takes more than 7. The home ownership rate for Americans under 35 has dropped to its lowest level since records began. An entire generation priced out. Not by supply and demand, but by where banks chose to aim the money cannon. And they did not stop at housing. Corporate lending followed the same pattern. Banks poured trillions into leveraged buyouts, stock buybacks, and financial engineering. Between 2010 and 2023, American corporations spent over $8 trillion buying back their own stock, funded largely by bank loans. $8 trillion of newly created money flowing directly into stock prices, inflating the portfolios of the top 10% who own 89% of all stocks. Meanwhile, bank lending to small and medium businesses, the engines that create 70% of all new jobs, has been declining as a share of total credit for 2 decades straight. Banks do not want to lend to a bakery. A bakery has no collateral. A bakery might fail. A $3 million house in suburban Dallas will still be there if the borrower defaults. So the money gets created, but it flows upward, into assets, into portfolios, into the hands of people who already have collateral. Never downward. Never into wages. Never into the parts of the economy where you live. And then, in March 2020, the Federal Reserve did something extraordinary. It set the reserve requirement to 0. Banks had been required to hold at least 10% of deposits as reserves. A thin guardrail, but a guardrail nonetheless. In one announcement, it was gone. Banks are now required to hold exactly $0 in reserve against the money they create. The already fictional textbook model became officially, legally, completely irrelevant, and nobody talked about it. This mechanism is not new. It is 330 years old, and every time it has been discovered, the same thing happens. The goldsmith bankers of London figured it out in the 1660s. They held gold for customers and issued paper receipts. Then they realized something. Not everyone comes for their gold at the same time. So they started issuing more receipts than they had gold. Lending money that did not exist. It worked until too many people came for their gold at once. Bank run. Collapse. Panic. In 1694, the Bank of England was chartered with the explicit right to do the same thing. Create money through lending. The entire British Empire was financed this way. Wars, colonies, railways, all funded by money that banks created from nothing. In 1929, banks had created enormous amounts of money through margin lending, loans to buy stocks. When the bubble burst, the money vanished. 12 million people lost their jobs. 9,000 banks collapsed in 4 years. The money supply contracted by a third, not because physical cash disappeared, because the loans were defaulted on, and when loans die, the money they created dies with them. In 2008, the same pattern. Banks had spent the 2000s creating trillions of dollars through subprime mortgages, loans to people who could not pay them back. Each loan created new money. Each new dollar pushed house prices higher. Each price increase justified more loans, until it stopped. And when it stopped, $14 trillion in household wealth evaporated in 18 months. Not because someone stole it, because the debt that had created the money went bad, and the money ceased to exist. And what did they do? They bailed out the banks, not you. $700 billion in TARP funds, $3.5 trillion in quantitative easing. The banks that had created the toxic money were rescued with even more new money. Not a single senior executive at a major bank was criminally prosecuted. 0. And the banks that were too big to fail in 2008, they are bigger now. JP Morgan's total assets went from $2.2 trillion in 2008 to $3.9 trillion today. They did not learn a lesson. They learned that they are untouchable, because the system needs the banks to keep creating money. Without bank lending, there is no money. Without money, there is no economy. The banks are not participants in the economy. They are the economy's central nervous system, and they know it. Thomas Jefferson understood this 2 centuries ago. He wrote in 1816, "I sincerely believe that banking establishments are more dangerous than standing armies." Andrew Jackson killed the Second Bank of the United States and paid off the entire national debt in 1835, the only time in American history that has happened. He called the bank a monster and said the people did not intend to confer authority to create a moneyed aristocracy to lord it over them. They knew. 200 years ago they knew. And the system rebuilt itself every time. So here's what this actually means for your life. Right now, your mortgage did not transfer someone else's money to you. Your mortgage created new money that inflated the price of the house you were buying. The seller got paid with money that did not exist until you signed the loan. And over the next 30 years, you will pay back more than double the original amount, with money that someone else's debt will have to create. Your debt is their profit. Literally. Interest payments are the primary revenue source of the commercial banking system. In 2023, U.S. banks collected $685 billion in net interest income, nearly $700 billion, extracted from loans on money they created for free. And the system needs your debt to survive. If American households stopped borrowing tomorrow, paid off their mortgages, their student loans, their credit cards, the money supply would collapse. Total U.S. household debt stands at $17.5 trillion. Student loans, $1.77 trillion. Auto loans, $1.6 trillion. Credit card debt, $1.14 trillion. Mortgages, $12.6 trillion. That is not an accident, that is the fuel. This is why they need you to buy a bigger house. Take out a longer car loan. Finance your education. Use buy now, pay later for a pair of sneakers. Every new loan creates new money. Every repayment destroys it. The economy is a treadmill, and the speed is set by your willingness to go into debt. Slow down, and the system collapses. Speed up, and asset prices rise further out of reach, requiring even more debt to participate. 2% inflation per year is not a natural law. It is the minimum rate of new debt creation required to keep the system from contracting. The Federal Reserve does not target price stability. It targets the rate at which your purchasing power must decline so that the debt machine keeps running. And here is the final piece. When you default and when you cannot pay, the bank does not lose the money it created. It already collected years of interest payments. It takes the collateral, your house, your car, and the debt is written off, which destroys the money, which tightens the money supply, which makes it harder for everyone else to repay their loans. Your failure is baked into the system. It is not a malfunction. It is a feature. Because the game needs losers. Musical chairs, remember? Fewer chairs than players. Always. They did not build a financial system. They built a debt engine, and you are the fuel. If this changed how you see your mortgage, your student loan, the money in your account, subscribe. Because this is the mechanism underneath everything else we have covered on this channel. The money printing, the bailouts, the inflation. It all starts here with banks creating money from nothing and charging you interest on it. They taught you that banks keep your money safe. The truth is, banks do not keep your money. They create it. They lend it. And they charge you for the privilege of using something that did not exist until you promised to pay it back. Every dollar is a debt, and the debt is yours. No, you don't debt.